money radio for a really great future. We're talking real money.
Hello, friends. Welcome to the Talking Real Money podcast with me, Don McDonald, and your friend Tommy Tangent. Yes, it's time to talk about money and anything that springs to mind here on the Talking Real Money podcast. Today, let's talk a little bit about you and others like you who do some dumb things. We all do those dumb things because we're, by definition, kind of dumb. Being human, we just do dumbness. Speaking of tangential, no,
here we go.
I'm already going. I started watching I love these documentaries.
What's on now?
The one about the woman in Utah.
Yeah, that comes up every time on Netflix, and I resist. I'm like, no,
I did it finally.
I don't know.
Debbie had watched a little of it, and I pushed the button. She goes, "Oh, I can't even watch the beginning of this thing."
Let's
talk about people being. Why are we so stupid? I don't get us anyway. But we're going to talk about how stupid we are with money. Now, I seem to remember. Now, by the way, this is not to imply any skill or knowledge on our part. We are as dumb as you when it comes to the future. We're all equally stupid. Although some of you think you're smart, you're really not. But I seem to recall that over the past, several years, maybe decades, Tommy Two-Tone and I have been flogging this whole silly idea of being invested outside of the U.S. And many of you have poo-poo-pooed us.
Not many, most.
Most. Yeah, you have. Oh, no, why should I be ever in anything else when the QQQ and the S&P are have done. You say doing. Are doing so well. We say have done so well. Means nothing about the future. And, what's happened to those that you loved lately?
Yeah, and there's been quite a differential, by the way, between international stocks and U.S. stocks, especially those concentrated in the Magnificent Seven and other types of sector funds there. You mentioned the QQQ. It's fascinating because going into the year, it was all going to be about America first, right? The new president of the United States, et cetera, was saying the tariffs, U.S., et cetera. And what's happened? The markets have responded by doing the exact opposite. It's fascinating. Absolutely fascinating. So, for example, iShares MSCI Germany ETF, well, that's up almost 25% year to date, right? The iShares
22-ish.
The ICMSCI ACWI XUS ETF.
No, hold on, you really did that badly.
I did do it.
The iShares.
Thank you.
MSCI
ACWI.
I
got that part.
All cap.
Yeah.
World Index.
XUS.
Yeah. Without the United. Okay. No. So very simply, it's the entire international equity market.
Yeah. I just think it's when you say X, it brings up emotion in me that probably shouldn't be there.
But the fact is, you threw out all those letters and everybody's going, IMSCI, ACWI,
What's he talking about?
US.
You're talking about the stocks other than the U.S.
Other than the U.S., yes.
Which is up about 10% year to date.
And that's just year to date. That's 2025 alone so far.
But here's the part that's fascinating. When you take that and then you compare it to the Standard & Poor's 500, which has been up and down, that has down about 5% year to date. So there's this 15% difference. About 15. I'm trying to be general here. And the same thing with technology. Bitcoin, don't get me going.
Oh, we're not even going to talk about that. The triple Q down about 5.5% year to date, or it was down about 5.5% year to date mid-March. But what does this point out? What does this tell investors? That we should have known and should have just suddenly gotten into international stocks in December?
Well, you're reading the headlines now. There's one at Morningstar. It's time now for international funds to shine. Well, we don't know that.
Well, we know they have shown a bit.
A bit of shining going on. But the thing is, as we've told you, always be globally diversified. Don't try to find the place that's going to be best, the place or the sector or the stocks or whatever it is. because doing that is a fool's errand, right? I mean, sort of chasing the things that have been good.
Foolish, and we continue as investors and gamblers to behave in very foolish fashion, which is why it always fascinated me that a company that was designed to help people invest called themselves the Motley Fool. I guess it's ironic.
Well, the irony was they're thumbing their nose at the conventional, right? I mean, the fool, the jester is allowed to thumb his or her nose at power and say, yeah, this is a little silly, and not lose their nose or their tongue or whatever it is, right?
Yeah, I was going to say, you thumb your nose too much at the king,
find a new gig.
Lose your head.
Exactly.
At least according to Game of Thrones.
Yeah, I don't want to go there. But, I mean, do we see this? And yes, am I disappointed in the Motley Fool? Very disappointed, because I can remember when they're kind of getting going over 20 years ago. First, they said mutual funds are bad for the reasons that you and I would say they're high expense, active management, et cetera. And now they're right in the same game. If you go to their website, from 5 years from now, says the headline, you'll probably wish you'd started investing with Stock Advisor, which has made far more money than the S&P 500. Going back a few years, I guess I'm looking at since they say 2002. Now, I have no idea if those numbers are accurate. I have no idea how much risk they take, because they're talking about the top 10 stocks to buy, detailed analysis of companies, all the things that, again, when they started, they said that's a fool's errand, and they've fallen right in with that, which I absolutely 100% hate.
Yeah, and the thing that trips us up as investors, well, not me, but you apparently, are these foolish notions and foolish concepts and foolish products that for some reason, if somebody writes a glowing article about them, you think you should try them out.
I got a new one for you, too.
Yeah. What do you got?
Well, Defiance ETFs launched its flagship Battle Shares Fund, ticker ELON.
Wait, that sounds like a familiar
You recognize
name.
It gives owners double exposure to Tesla, coupled with a short on Ford Motor. Remember,
it's the Tesla versus Ford ETF.
Exactly. It's the bet against the Detroit automaker and betting on the EV market. EV maker shares Tesla, TSLA. Well, how has that worked out here for people that jumped in? Because that's an easy trade to see.
Well, it's funny because the fund started. I want to just get the exact date for you, because
not that long ago, I don't think.
It started on February 13th of 2025.
Yeah, so it's been around for.
So you could start making this bet,
few weeks,
investing in this. Oh, how expensive is it? Let's find out. That's another one. 1.3% expense.
Well, so it made them a lot of money.
It didn't make them a lot of money, but because Tom, they have total assets of $750,000.
Okay, so they're getting going. It's warming up.
But their return so far this year
is
negative 64%.
Ooh, I don't like
they've
things
lost
in my
65% of their value.
2/3 of the money has gone away. And by the way, in the U.S. alone, leveraged funds exceeded $130 billion in assets in December. Leveraged funds, $130 billion with a B.
See, leverage. Really? We and this comes from the real estate industry. I blame the real estate industry for this and our preoccupation with buying homes and thinking they're great investments. And that is, leverage can dramatically enhance your return, as we see in stock or in our real estate, because you put 20% down and the price goes, doubles, you make a fortune. You make more than a double. It doesn't work, though, when things go down, as the Tesla versus Ford ETF found. Tesla stock plummeted and Ford's rose.
Yeah, who would have saw that coming? I love what Defiance says about the fund. This is the ELON. It provides investors with a unique opportunity to gain exposure to the ongoing transformation within the automotive sector, capitalizing on the divergence between innovation and tradition.
In other words, we don't know why we made this fund, other
Well, we
than
know
to
why.
try to make some money,
Yeah.
and it did not work out so well for us because with $750,000, what's their fee times 0.01?
Please don't do this on the fly. We just got another email from somebody saying,
I fixed
run
it.
the numbers right.
Okay, so $750,000.
Not $700, right?
No, it's $7,500. I actually used a calculator this time.
So
$7,500. This
you know.
company has made a whopping 75. Well, wait.
Wow, you've lost 66% of your money.
Hold on. I'm
Message
sorry.
received.
I did that wrong.
Oh, okay.
They have made so far, because they don't charge a year's worth of expenses in just a month. It's been a little over a month.
Yeah.
They've made about $675.
While you've lost fill in the blank.
They went to all the trouble of bringing this fund out to make $675.
Now you got to wonder after this recent publicity if that will bring in a lot more money, right? The fact that they got this article written about them, et cetera. Well, that people rush in.
I would hope whoever funded this operation pulls all of their money out and shuts the dumb thing down.
I hope so too. But let's talk about financial fools for a moment.
Financial tomfoolery.
That's because that's what we were talking about. I mean,
tomfoolery.
I love that. So, I mean, the fools you don't want to pay attention to are the people that trade frequently, right? They're buying in and out. They're responding to whatever's going on in the market. Yep.
Yes.
They respond to their feelings and intuition. Right?
See, the problem is they confuse feelings and intuition with foresight.
Yeah. They believe that now is getting to
believing you have foresight is foolish.
Yeah. Getting to that. They act on things that they think they know that others don't. That happens all the time.
Yeah. And they for some reason, they believe that because they read it in the newspaper, only they knew it. Or on the online newspaper. Yeah. Do you realize that more than one person read that same publication you read? That's moronic.
Imagine if
I'm going to use a new word every time.
Moronic.
For foolish. Yeah, moronic.
Imagine if I acted on the stuff I read in the Wall Street Journal, which I read in the afternoon, the printed version. Anyway, so
you'd be imbecilic.
Really silly. Number 3, they know someone who can outsmart the market. You hear this all the time. Well, I got a guy. And that's no offense against women. I got a girl. I mean, that has somehow been smarter, has seen the future, et cetera. Those are the fools you don't want to pay attention to. Now,
or the dimwits
that fool you do. Yes. That are sardonic in some way, I guess. I mean,
are you talking Don and Tom?
Exactly. They would tell you to buy a diversified portfolio and hold it through all the headwinds, through all the things that are coming at you. They would tell you to keep your costs low because that's paying 1.3% for ELON, that's nuts. Paying anything like that for a fund.
Well, yeah, crazy. You got that versus 0.03% for BND.
Yeah.
So yeah.
You take your pick. And then they would tell you to pay attention to taxes. Not all the rest of the tomfoolery that's out there.
That sounds so simple, Tom, which makes us, I think, simpletons.
I'd rather be the tomfoolery. It's more fun.
Well, at least you're not a bonehead or a numbskull. I love
I've been all those. I've been those too.
Can you tell I got my thesaurus out? Oh, yeah, mutton head. Yeah, dunderhead. Yeah, puddin' head.
So back to where we started. Yes, you should be invested internationally. Yes, you should always be invested in international stocks. No one knows what's coming next, whether it's going to be better here, better there, et cetera, et cetera. Expose your money to all of those places continually.
Don't be a dunce. Do it right.
What were some of the other ones? Those are pretty good. I got to write those down. Oh, I've not used that in like 30 years.
Ignoramus.
I think those are ones I used on my brothers and sisters a long time ago.
Well, I'm sure you use this in the Cock household a lot because you all were so smart. You used cretin.
I think it's cretin. And no,
it's cretin.
No, I think it's cretin. So
no,
anyway, we're going to have an argument
no,
about
no.
that. So I'm sure you're going to
okay, just looked it up.
Yeah?
It's both.
Oh, I love it when I'm right, only partially right. That's good.
It's cretin and cretin.
I call it cretin. You call it cretin. Let's call the whole thing off. All right, let's go to some questions. Thank you for that exhilarating open. Doug from Jasper, Alabama writes a lengthy question. So you got to hang with me, all right? Seeking a little confirmation that I'm investing in the proper funds, given the limitations I have at my job. Says, I will receive a pension when I retire, which may occur next year. Plan to wait on Social Security until 70 years of age. Good for you. My state job provides a deferred compensation 457 plan, which I've contributed to for many years. I also have a Roth IRA with Vanguard. Now, he says in his deferred comp plan, listen to this. It only has 3 options: S&P 500, a bond fund, and a money market fund. That is weird.
That's lazy.
That's weird.
Well, it's lazy. It's really, truly lazy. And it means that the trustees of the fund.
But maybe he's saying they only have those in indexes, not the other ones are actively managed. But that would be very limited.
Did he say that?
Nope.
Are you reading between the lines?
I'm reading between the lines. He splits it 75-25 in that plan. It doesn't say what's the 75.
Well, S&P 500 to bonds, probably.
Okay. Roth
because otherwise
IRA,
he'd say 25-75.
Thank you. My Roth IRA holds, you're reading between the lines, holds a Vanguard TDF, so I have exposure to international stocks to capture the small cap value side. My wife uses her Vanguard Roth IRA for that. I'm a bit concerned about being over concentrated in the U.S. Does this sound familiar? With the Index 500.
Yes, you are.
I plan to diversify by rolling the deferred comp to a Vanguard TDF. That's a target date fund at my retirement. That's less than a year. I should have TDF with the deferred comp money, a Roth IRA TDF, and my wife's IRA small cap value exposure. Is this a good asset allocation?
No, this is a mess. This is truly a mess because you've got this huge chunk that's just in the large cap growth arena through the S&P 500 fund. Your international exposure, while you've got it through target date funds, the equity portion is basically about it's about 65-35.
Is that in the TDFs? It is that ratio.
Yeah.
Okay.
Yeah, it's about that ratio.
That's not horrible.
No, it's not. But what I'm saying is because of your overbalance to the U.S. in your 457, you now need more international. You need to add an international portfolio. And by the way, you're not getting much in the way of small cap. You're not really getting a small cap tilt.
Now you listen, you nincompoop. Let me go back, okay? Not Doug. I'm talking to you.
Word.
Yeah, thank you, because I really like that one. Numbskull. That's a good one too. Here's what I would do. Since you're going to be moving the money in a year, I wouldn't change anything now. That's it. But here's what I would do once I move the money. Then I would say, okay, first, what do I want my stock to bond ratio to be?
Right. You got to know that.
That's first. Then I would say out of that, okay, I'm going to have 75% in stock, 60, whatever it is. Proper division between U.S. and international, large and small value and growth. Then I would do that account by account to try to figure out where to put it. You've done this a little bit with your wife's Roth IRA, but we didn't have the amounts because that's what's going to be important here, the actual amount of money in each one of those. But start at the highest level, work your way down, and then divide the accounts appropriately. Doesn't that make sense?
Yes, that makes sense. And you have time to plan and do all the things, get all the prep work out of the way. But again, it's a matter of understanding your risk profile, which is tolerance and need, really having the numbers down and making sure that you are at least close to the market's tilt between U.S. and international eventually, and that if you can, throw in a little small kicker.
Yeah, and if I can make a suggestion here, this is not a sales pitch, but if you're retiring in a year, probably should have a professional at least look over your shoulders, say,
maybe get
good.
A plan done.
Yeah, just to make it all work.
Pay the thousands of dollars for a plan.
I know. This is your retirement. Yeah.
Yeah, it's your future. It's your whole thing. By the way, you as a child were probably a big Three Stooges fan, weren't you?
Oh, I used to do that thing with the nose with my brother all the time.
I knew by your enjoyment of the words nincompoop and numbskull.
Well, there were 3 of us, so what could you say? Michael writes from Mechanicsville, Maryland. Can you discuss buffered exchange traded funds? It sounds like an index annuity.
Buffered exchange traded
ETFs.
funds.
Yeah, we've discussed these prior.
Oh,
on the
that's
program.
right. We have. Yes,
Yep.
yes.
Not a fan of buffered ETFs.
Well, because they're hedging.
Yep. And in a variety of ways.
But they're not. They're not an indexed annuity. I'm telling you,
they're not an indexed annuity.
They're better than an indexed annuity, but they're not. Hedges I don't generally like. I need to find a symbol for one because let's use an iShare. Oh, IVVM. There's one right there. And I got to go back to Morningstar. I just want to see what's in this portfolio. IVVM. Shares, large cap, buffered, ETF. Ooh, look at those expenses. See, this is one of the problems.
High expense.
They're
There's
more
the algorithm that is built, right? This all comes down to the person who designed it that said, well, if we do it this way, then we make this much and we only lose this much. I mean, the idea behind a buffered ETF is market exposure with less volatility, correct?
Yeah, and I'm looking at what they're using for volatility. They're using futures contracts. They're using it's all equities with like futures contracts and the like, and options, and they charge a lot more for it. And I haven't looked at the performance of one in a while, but they do. Well, they have so far, given that this portfolio is U.S. large cap centric,
as you would expect.
So it's the S&P 500 basically hedged is what they're doing. So they've done better this year than has a S&P 500 fund.
Which is what you would expect, though, especially in a volatile market.
Exactly. And that is the trade-off, is that you're going to get less in up markets and lose less in down markets. But here's why that's a foolish strategy. Speaking of foolishness, because markets have in the past gone up more than they've gone down. You had more years up than you've had years down.
It's about 75% up, 25% down.
So if you're protecting yourself in downs, then you're giving up the ups. And here's a perfect example. This fund, it's a perfect comparison. It was with an S&P 500 fund. The Vanguard VOO has an expense ratio of 0.03. 0.03.
That would be 3 basis points, 3 100ths.
Yeah. The BlackRock Outcome Fund has a expense ratio of 0.5. Its return last year was about 16%. The Vanguard Index, or the S&P 500 fund last year returned 25%. The Vanguard fund has lost about 3.25% so far this year as of whatever date we recorded this, the 20th.
Yep.
And that fund has lost 0.75%.
Okay. I mean, this gets back to how you deal with volatility. Our take would be you have a certain amount of stocks and a certain amount of bonds in widely indexed type of funds. Their take is, look, you can have your cake and you can eat it too. You can make market-like returns with less downside. We're disbelievers of that because we've seen a lot of people say that over the last 30 years and it hasn't turned out.
At least the buffered ETFs, they're not really saying that, which is why I really hate indexed annuities. What they're saying is you can still participate in the market without as much of a downside. What the guys who are selling and the gals who are selling these nearly crooked exchange-traded funds say, and I believe that this is a big lie, that you will get, and they say this only through their mouths, you will get the return of the stock market with none of the risk.
Good point. Yeah, that's fair. That is a dramatic difference.
You don't get that.
Yeah, that's true.
And I could go through all the reasons why you don't, but I just did that on a recent episode of Stacking Benjamins.
Yeah, okay, so you can tune in stacking. So, I mean, another reason is you have liquidity in a buffered ETF. You can get your money tomorrow. Can't do that in equity index annuity.
No, in equity index annuity,
No.
you could pay 12% to get out.
Yeah, that would be, again, so there's a lot of things, but thank you for the question. It's a good one. Our take is stocks and bonds and cash if you have to, not these products that sort of, again, give you some part of the market and less downside.
So there's foolish, and then there are simpletons like us. Just keep it simple. Tom.
Simple Tom.
Simple Tom.
Simple Tom.
Yeah.
All right.
Not tomfoolery, simple Tom.
I like tomfoolery better, but that's just me. So thank you.
Take
Great questions. Keep them coming, by the way. We take your questions. We take your calls. How are you doing on your calls? Your call
much better.
Okay.
Much better.
People
the Q&As now I've kicked up to five questions per Friday episode now.
Good. All right. So the lashing you gave everybody paid off.
Yep. I still got a lot of Bitcoin Bob ones that I just delete. But
yeah.
Otherwise, they're coming in really well. Thank you.
And by the way, some
of
you write 2-page questions. Now, I try to call those people to answer because we can't
answer those on the show. They're too boring.
I'm sorry. Long. Well, it's complicated.
They're complicated, and I'm sorry for the listeners. They're boring.
I'll let you say that, but you can send in whatever you like. Either you'll talk to me, or you'll get it answered on the podcast, et cetera. But we're here to provide
answers.
If you
speak 2 pages when you call in, I am going to edit you.
And my grandsons will laugh because they have to listen to that every Friday afternoon, which they love. So,
don't listen this Friday.
Oh, okay.
Don't listen this
Friday.
Friday.
Well, we're going to Snow White too, so we'll see.
Yeah, don't listen this Friday.
All right.
No. I don't want them hearing what people have to say about their grandfather. Don't.
They'll be going, wait, did they just say something bad about you, Grandpa?
Oh, wait. For those of you listening to the podcast, this Friday was, hold on. I got to tell you when.
I don't know when all this stuff airs.
It's so confusing.
It's complicated.
I don't know when I was on Stacking Benjamins. Let's see. What is today? Today's the 20th. So it's the 12th. It was like 2 weeks ago on a Friday that happened.
All right. So they're over it now. We're okay.
Are you better now?
I feel just fine. Thank you so much.
That's
really it. That's all I got.
It's like we predict the past.
Or the future. We're very good at telling you what had happened 2 weeks ago, 3 weeks ago.
And by the way, if you just want to talk with us, like have a conversation, we actually take live calls on Saturday. It's really easy. You just call on a Saturday, starting at 3 p.m. Eastern Time.
That's noon Pacific.
855-935-TALK, or all the other questions put in through talkingrealmoney.com.
We get people calls from all over the country. It used to be just Seattle, right? Because the show's
we get people who call us from all over the world. We got our Canadians.
That's true.
We had a
Ottawa
Pole once. We had a.
He didn't call live, did he? From Poland? I can't. No, I think that was a recorded thing. But the Canada, they called live, and that's good before they cut off the phone.
Yeah. You don't have to use an international calling code from Canada to the U.S.
Good point. Good point. And the phone still works between the two of us so far.
Because soon they'll be the 51st state.
We're not supposed to joke about that. They don't think that's funny.
And actually, come on.
No,
if
no
we're going to take them over,
no,
we would not make it the 51st state.
All right,
we
then
would make it
then the United States can become
51st through 60th.
Then we're going to become the 19th
provinces.
We're going to become the 11th province of Canada. Then we should take that joke if the other one's funny. So
I think being the 11th province is hysterical.
All right, there you go. How's your French?
Good luck. No, I have never heard a Canadian prime minister suggest that because they don't want us.
I wish they would. That might make for fun.
They just don't want us that badly.
Sorry.
Apparently,
yeah.
No one's asked for us.
Well, our hockey's gotten better. You think they'd be okay with it, but apparently not. I guess so.
And now we play football professionally in America.
There you go.
Not NFL, the other kind, Tom's kind.
The cheese is good too. So
you bought a team.
I did. I bought a small part of a soccer franchise. So I'm now an official. Well, I'm not actually. I haven't signed the paper yet, but I told them I would. So
this is MLS?
No.
Keep
going down. Keep going down.
Yeah.
Couple divisions below that. So pretty exciting.
You're gonna be a soccer.
I get a free sweatshirt or something. They said. So there you go.
Are you seriously investing in a soccer team?
Yeah, I am.
That's when somebody has way too much money. Folks.
Yeah, back to the Fools thing. You remember you were talking about that?
Way too much money. Plus, I've heard that sports franchises
Very illiquid. Could go bankrupt.
Tend not to be very good investments. So now you've got farms and sports leagues.
I know. I'm invested in a lot of wacky things. So we'll see how it works out. I'll keep you posted.
Position, heal thyself.
Start here. Let's see how it works.
All right, everybody. Oh, look, we're coming up on the 30-minute mark. We better go. Thanks for listening, and please tell a friend or two, and join us almost daily as the two of us are talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.